Steve has over 25 years' experience as an investment banker and financial advisors to financial institutions across the country. He has negotiated hundreds of mergers and acquisitions of banks and thrifts, as well as advised on branch acquisitions, divestitures, capital raises, and other strategic initiatives. Interestingly, Steve also serves on two community bank boards, one on the West Coast and one in the Chicago area. And Steve and his brother, Eric, also owned a bank in California, the Sunset Bank with total assets of $232 million, and Baltimore Bay Bank with total assets of $126 million. So Steve certainly understands the challenges that directors face because he is one himself. Please welcome Steve Hovde.
Thank you, Jack. Appreciate it. Good morning. Welcome to Chicago. Hopefully it's not too cold for you who aren't accustomed to fall in the Midwest, but it's certainly much better than the East Coast right now. I'd like to thank Bank Director for having me here today, and more particularly put in a pitch for an excellent conference that they have every year in Arizona. And this coming January 27th to the 29th at the Phoenician, they have the Acquire or Be Acquired conference. It usually has 600, 700 attendees, and if you're ever interested in your bank making acquisitions, that is definitely the conference you want to attend. Today, I'm going to talk about the state of the banking industry. There's two major themes. One is that banking is the case of the haves and have-nots. Some banks are much more fortunate than others, either from a credit quality standpoint or an earnings standpoint. The other major theme and more important theme is from an operating standpoint. Are we a glass half full, or one could argue more strongly we're a glass half empty with a slow leak in it? So we're going to touch on some of these ideas and look at what's going on in the banking industry. But to do so, first we have to look back to understand where we are today. The banking industry as we sit right now has been a lost decade, a lost 12 years. This graph looks from the start of 2000 through 2012, and you'll see that the banking sector is down about 29%. In contrast, the S&P 500 is down only about 2%. If you go back all the way to the early 1990s, this is about where publicly traded banks were coming out of the last crisis in the late 80s, early 90s. So in some respects, the banking sector is a lost two-decade. More particularly, I talk these days to a lot of strategic board committee retreats, and I talk about the good old days, and it makes me feel really, really old. However, the good old days to me are back in 2005, 2006, and the first half of 2007. Because if you look at this chart, just from the start of 2007, and obviously the crisis really started to unfold in the summer of 2007 and early 2008, but the banking sector's down almost 60% compared to where publicly traded banks were before the start of the Great Recession, whereas the S&P 500 is roughly break even. It's recovered from the Great Recession. So some days I'm feeling good and I'm optimistic and I'm thinking things are recovering. Other days I look at the news, I look at bank earnings and I'm thinking, oh crap, where am I going to go over the next 5 years? As Jack mentioned, my brother and I own a bank in Southern California, SunWest. That's about $650 million in assets, $80 million in capital. So in addition to our investment banking practice, we live and die by how well the banking industry is doing from an investment standpoint also. We started 2012, and it felt really good in the first quarter. And then, lo and behold, the European debt crisis kicks in the April and May. Bank stocks got hammered again. And by June, we were almost back down to where we started the year. Curiously, we've picked up very nicely, again, almost recovering what we had in the first quarter. A lot of that I attribute to QE3. Why that has helped the banking sector so much, I still struggle with. In general, could the economy pick up with QE3? Could housing come back? That will help the banking sector, as we'll see. On the other hand, I could make a strong argument that QE3 and the Fed's current low interest rate environment is going to devastate the banking sector. So we talk about the have and have-nots. Sad to say, this is still an environment where the large are favored over the small. If you look at the depths of 2009, March 2009, recall what was going on. We had a banking crisis really embroiled. Questions as to whether the largest banks would be nationalized, B of A, Citi, institutions like that. The Treasury did the stress test, and lo and behold, the large cap banks blew the socks off once it was figured that they're not going to be nationalized. So in blue, we have the large cap stocks up roughly 200% from the dredges of the market. In contrast, the micro cap stocks, which the vast bulk of the community banks are only up about 30%. So another case of the have and the have-nots. Investors these days, in contrast to the mid-90s and in contrast to 2005 to 2007, simply are not that interested in community bank stocks, particularly on the smaller end. It also is reflected in their trading levels. Right now, the sweet spot in banking from a trading standpoint is about 5 to 10 billion in assets, and the 1 to 5 billion in assets is just slightly less from a trading standpoint. Again, the smaller banks generally trading at book value or a discount to book value. More particularly, another way of looking at the collapse is back in the second quarter of 2007, banks traded at about 170% of tangible book value. Now the average bank trades at about 90% of average book value. But another case of the have and the have-nots. It's regional. So if you're from Texas, if you're from the Southwest, or if you're from the New England states, those markets have held up much more attractively than, pity those poor people from Atlanta or from Florida. Or curiously, people don't realize it, but one of the epicenters of the failed bank area is Chicago. We've already had 35, 40 banks that have failed. And Minneapolis is another big area. So again, a regionalized effect, and certainly from both a trading value as well as we'll see from an M&A standpoint. What's also hurt bank stocks? Dividends. The big banks, obviously, and small banks have all pulled back significantly. Used to be you could be an investor in bank stocks and have a nice dividend flow. Well, it used to be you could be old and invest in savings and CDs and have a nice interest flow. Those days are over. Whether the bank industry will get back to a strong dividend payment yet, I still say that that's to be determined. A large part of it's going to be the capital rules. So, where are we right now? We have about 7,000 banks. If you think about it, that's down from about 15,000 banks in the early 90s. We have about 1,200 publicly traded banks. Many predict that over the next 3 to 5 years, we could see the number of banks decrease from 7,000 down to the 3 to 4 to 5,000 level. I believe that's going to be the case, and I'll talk about some of the reasons why. What's facing the bank? So are we at a glass half full or are we at a glass half empty right now? What's some of the headwinds? Loan demand. Without economic growth, there is simply insufficient loan demand for banks' balance sheets. Dodd-Frank and the regulatory burdens. Hopefully there's not too many regulators here, but all I can say is I thought they were bad in 2009. They got worse in 2011, and they're still crazy. I mean, the banking industry is under obscene pressure from the regulators, and they're under pressure from Congress because you all, as bankers, have been painted as the ones who created the financial crisis. That's a bunch of, bahooey or whatever, malarkey, as Joe Biden would use, but nevertheless, the banking industry has been paid in that fashion. Non-interest income challenges. Obviously, the Durbin Amendment and Dodd-Frank and stuff like that has made it difficult to grow non-interest income. QE3. Again, is it good for the economy in the sense of keeping interest rates low so housing values can start to recover? We're starting to see signs that it's working. But at the same time, we'll touch on in a little bit, what's the effect of this super low interest rate environment? More particularly, how does the Fed start to unwind its rather large balance sheet that is much more massive in size than before we came into this crisis. Another headwind, big government. Obviously, we have a critical day tomorrow. It will affect the direction of where we go. What we do know, however, is that we're running spending levels that are roughly $1 trillion larger than we were back in 2007. So they talk about how do we come up with spending cuts. I don't know, I didn't think it was all that bad back in 2007. Obviously, we're spending a lot more. More particularly, right now, it's the Fed that is financing a large amount of government spending. How will that play out over the next few years if the Fed stops or if the deficits continue at $1 trillion a year? How are they going to be financed, and what's it do to interest rates? The effective interest rates will clearly impact the banking sector, as we'll see. Obviously, we've got a debt issue. I'm not going to pretend I'm going to be the economist up here and tell you what's going to happen over the next 5 and 7 years as we wrestle with the debt issue. Clearly, tomorrow is important, and the fiscal cliff at the end of the year is important. Some have said that if the fiscal cliff hits, we're going back into recession early next year. Is that the glass half empty? And for that matter, not only a small crack in the glass, but a very large crack in the glass. Dodd-Frank, what's some of the positives? It was supposed to be geared towards the big banks. Sad to say, it's now trickling down. This is kind of like supply-side economics, only this is regulatory trickle down. I'd argue it's not trickle down, but it's waterfall down. On a positive, it has put the non-bank financial players at long last on a level playing ground with the banks. So think about yourself, but think about the mortgage bankers. Think about the mortgage brokers. I mean, they are fearful as can be of the effects of Dodd-Frank and the CFPB. So, the smaller banks could arguably not be as badly hurt as the big banks, so that's a win for the community banks. What other headwinds are the community banks facing? Obviously, mobile banking. I have 4 children, ranging in age from 18 to 30. I don't think any of them ever step a foot in the bank other than the first time they open an account. Everything on their end is done technologically. So what's that going to do? Certainly the big banks have mobile banking platforms. Will technology allow the community banks to continue to adapt? I believe yes. Declining fee income. I would argue that the DFA, the Dodd-Frank, favors largeness. Again, the have and the have-nots. Simply witness what's happened with Wells Fargo pre-crisis, post-crisis with respect to their complete dominance now of the mortgage market. And was that an intended consequence of Dodd-Frank and the regulatory structure where now suddenly Wells Fargo and JP Morgan dominate the mortgage market in the United States? As we'll see later, big banks absolutely have much more access to capital compared to small banks. And from an economy of scale, they can clearly much more readily handle the burdens that are coming down. From a positive tailwind, there's going to be a lot of external growth opportunities for you banks out there that want to be an acquirer in order to either build market share and or become more efficient by consolidating duplicative operating costs. I believe we'll probably see the biggest tsunami wave of bank M&A over the next 3 to 5 years that we've ever seen. So for those of you who want to be an acquirer, it's going to be a very good time. For those of you who want to be a seller, timing's going to be critical. You don't want to be a day late or a dollar short. So, glass half full, glass half empty. We talked about DFA, and I think the biggest thing is it levels the playing field for the community banks vis-a-vis the non-bank sector. Glass half empty and favors the big banks. Well, Congress in their omnipotence said, hey, we can't have these too big to fail banks. Well, guess what? We went through a major recession, and they're a hell of a lot bigger now. So is that an intended consequence? So if we had too big to fail banks before the crisis, they're way too big now, and obviously government can never let them fail. Positive. ROAs are starting to improve. About 25% of the industries now a 1 ROA or higher. A vast improvement from where we were in 2009. However, think about back to the good old days when a norm, a 1% ROA, was absolutely a norm. Can we get back to 1 ROAs? Another big positive, credit quality is improving. We had a massive spike in NPAs going into the Great Recession, and thankfully for the last number of quarters, NPAs continue to decrease. In fact, if you look at the entire earnings power being generated by the banking sector right now, and in large part why you're seeing increasing reported quarterly earnings, it's due to the decrease in NPAs and the resulting decrease in loan loss provisions. One of the questions we'll touch on is how low can loan loss provisions go? I've seen a couple of publicly reported earnings where they haven't taken a loan loss provision in the September 30th quarter or in the June 30th quarter. We certainly can't go to a situation where we go below zero. From different asset quality classes, everything's slowly but surely improving. Even construction and development lending, which is the highest level of NPAs and charge-offs. One issue, however, today is, as we know, the regulators are saying don't go into CRE, don't go into construction and development lending, stick with C&I lending, that nice little red line right down there. Well, heck, competition for C&I loans are very, very intense. So what's that doing to the industry is everybody tries to migrate out of CRE and construction and development lending into C&I lending. In fact, you look at Atlanta, the epicenter of failed banks, as we'll see. There were roughly 60, 70 banks that opened up between 2000 and 2006. They all went in construction and development lending because Atlanta was hot and they borrowed off brokered CDs and retail CDs. That's why Atlanta now is the epicenter of FDIC failed banks. So the regulators still don't want you going into CRE lending. Certainly don't want you to do construction and development lending. Are there enough asset classes left for all the community banks to be in? Improving credit quality is showing up in net charge-offs. I used to be an accountant, used to be a lawyer. I guess I'm going down the respectability chain, accountant, lawyer. My brother ran for Senate in the United States, so he's gone all the way down. I'm not sure what's lower than a politician these days, but maybe I'll get there. However, if you look from an accounting standpoint, you're supposed to not smooth out earnings or use any particular quarter, but you look at the fourth quarter of each year, and there seems to be a nice spike every fourth quarter as far as cleaning up the balance sheet and the income statement. On a positive basis, however, the fourth quarter of each year has clearly declined in the level of net charge-offs, and I would expect that will be the same. There was not enough publicly available information when we had to have this presentation out on October 15th with respect to the third quarter, but I'm expecting the third quarter will likewise be lower than it was in 2011, and the fourth quarter upcoming will be another tick down. So another positive trend. What's really remarkable is tangible common equity at the banking industries is higher than it's ever been in the history of the banking industry. Goes back to a common theme, though. The regulators want capital, capital, capital. You seemingly can't have enough capital, and that goes back to the question of will dividend levels ever get back to as robust a level as we've seen before as banks are being strongly encouraged to keep more and more capital. One of the negatives is the old forms of regulatory capital for the community banks in large part have totally disappeared. On a lot of the M&A work we used to do, the buyers would finance their acquisitions in the good old days with TRUPS. You could get a bank to call down 10, 15, 80 million of TRUPS within 2 weeks, use that regulatory capital to finance the acquisition, didn't dilute common shareholders at all, very low cost, tax deductible and counted as capital. Well, when the CDO market imploded in August of 2008 or 2007, so went TRUPS. And obviously, Dodd-Frank and the regulatory structure realized that TRUPS being bought and sold by banks within the banking sector wasn't the healthiest thing for the sector, and now TRUPS have to be grandfathered out. But tangible capitals are nice and strong. Well, here's probably the biggest issue that causes me to believe that maybe it's a glass half empty with a crack in it. Net interest margins are under intense pressure, and they've been dropping quarter after quarter, and I believe they will continue to drop if we keep the current low interest rate environment. It's this simple, folks. If the Fed keeps interest rates at 0 until 2015, I'd say 95% of you guys have already repriced your deposits about as low as you can get them. We know banks in California we work with that have deposit costs of 14 basis points. Our bank has a deposit cost of 18 basis points on over $600 million in deposits. You really can't take it much lower. However, with no organic loan growth, certainly securities aren't earning anything. I had to do an appraisal for a large estate, and the estate lawyer and the IRS counterpart were grilling me last week. Well, how can you defend a valuation that's roughly 50% of book value for a privately held bank where 19% of the stock is held by this estate? I said, gentlemen, realize your funding costs on average are going to cost you 50 basis points. Your operating costs are going to cost you somewhere around 2 to 2.5%. Some will be a little bit more efficient. But all in, you're going to be running at least 2 to 2.5% between funding costs and operating costs. You can't earn anything in the securities market. So anything that you have liquid on your balance sheet, you're losing money on. As long as we continue to see loan to deposit ratios go from what had been almost 95% pre-crisis down to 75% and below now and continuing to drop, you've got a third of your balance sheet you're losing money on. The next big issue, however, is even in loans, I can't tell you how many bankers I talk to where their best customers are attacked by your competing banks in your markets, where they may have a loan that's at 5 or 6% right now. They get a flyer. I was up in Wisconsin last week, and BMO Harris came out with a flyer promising 5-year loans at 3 5/8. And a good customer of the bank called up and said, I'm at 6%. I like you, but I'm not going to pay this. So they had to rewrite the loan. I was talking to Bob Yohannan from First Evanston this morning, a great bank here in the Chicago area. And loan competition, if you're a good borrower, you can get cheaper rates now than you've ever been able to get in history. The question is, will the banking sector start to sink to do not so credit quality borrowers? But for the credit quality borrowers, if you're repricing every loan down in the 4s and in some cases the 3s, even in the loan portfolio, your net interest margin's under attack. This is my biggest worry for the banking sector. If Obama gets reelected, if we run these trillion-dollar deficits, if the Fed has to finance them, the Fed has to keep interest rates low into 2015, maybe below. Because guess what happens if they raise interest rates? Our cost of debt on the Treasury is going to skyrocket. So the Fed's caught in a wicked hamster on a wheel, just running. Well, as long as they keep interest rates super low, net interest margins are going to continue to get hammered. And again, a case of the bigger favored, they have higher loan to deposits. Naturally, one of the reasons is, unlike community banks, they don't fully fund off deposits. One last concern I have is the commercial mortgage-backed market still has a lot of debt that has to reprice. How will that play through, even though I'm a little more positive here, because as investors are looking for yield, they're starting to flow back into CMBSs, they're starting to flow back into junk bonds, and with no yields in the economy, lo and behold, I think we can work our way through this all over again. So where do we end up? This is my guess. Fed says they don't want inflation. My guess is they actually want a little bit of it to help asset values recover. So we're probably going to get back into an inflationary period at some point in time. We do have a debt crisis. There's no ifs, ands, or buts about it. I'm still amazed that the United States populace hasn't woken up to it and realized just how bad a debt crisis we have. Folks, we're getting really close to Greece. And no matter who wins, the likelihood is we're going to have increased taxes with depressed growth. That's not a good formula for the banking sector. Housing market, I'm going to touch on quickly. Here's the favorable. Here's where it's a glass half full and getting better. Obviously, we still have high foreclosures. California is still the epicenter. Go to Inland Valley and go to Stockton and Lodi and towns like that, and it's still pretty grim. Go to Atlanta, it's still pretty grim. Housing values won't come back in total, some are saying, until 2017, in certain markets well out after 2020. However, what we are seeing is inventories are shrinking, including the shadow inventories. Housing values have stopped dropping, and the last couple of Case-Shiller reports would indicate that they're starting to increase on a month-over-month basis. New home sales are still at ultra-low levels, but they're starting to tick up. And housing starts are starting to tick up. And more importantly, it's all due to the affordability indicator. People can afford to live in a house now for as cheap, if not cheaper, than renting. And obviously for foreclosures, in many of the epicenters of foreclosureville, whether it's Las Vegas or Phoenix, investors have come to the forefront and they're buying up all the foreclosures and turning them into rentals. So I think there's a light at the end of the tunnel, and this is one of the positive attributes for the banking sector. With rising housing values, we will hopefully have a recovery in the economy. Obviously, if we can get back to economic recovery, the intense loan competition should abate as there's more loans available for all of you. So hopefully the housing sector is one of those glass half full. What's all this done to bank M&A? Just like the trading values, bank and M&A has been hit. By the way, there is a session this afternoon at 3:15, What's My Bank Really Worth? We'll go into much more detail on bank M&A values, is more particularly how you value a bank if you're thinking about being a seller, or conversely, if you're thinking about being a buyer. But we got regulatory tensions. In these days, if you're not a 2-rated bank, you're not going to be a buyer, because the regulators simply aren't going to give you approval to expand if you're not 2-rated or better. Supply tensions. Right now, we're kind of at an equilibrium. Sellers coming to the market, buyers coming to the market. We're going to reach a stage, though, I believe, where there could be a whole lot more sellers coming to the market, and then the buyers can get pickier. When do the sellers go to market if they want to sell before that tsunami wave comes? And then pricing tensions. As we'll see in the next couple slides, things are starting to improve. Glass half full. Values are starting to rise, just like the publicly traded stocks rose through the first quarter, rose again in the third quarter. But in simple terms, 2 peaks back in the late 90s, 1997, 1998, again 2006, average bank traded about 250% of book value. These were number of deals getting done, the blue lines. Recession hit, remember that chart that looked at 2007 to currently? Well, here is the number of deals. They fell off the cliff. The deal value on sales has dropped to the lowest level over the past couple years than existed even before that in the last crisis in the early 90s. The average bank traded at slightly over book value, and plenty of them sold for less than book value. Now we are starting to see a slight pickup. From a PE standpoint, curiously, that's pretty much level. Historically, PEs on a trailing go for about 20 times trailing earnings, 20, 23 times trailing earnings. There's some variability in that during peak period of time. As Ernie knows, back in Florida, pre-crisis, good old days, we sold 42 banks in Florida, and the average price tangible book was about 350% of book, and it was about a 35 times trailing earnings. But that was an abnormal situation in the market, region specific. Now We're back to 20s, even though we had a spike, but that's more because of earnings are depressed than getting up to a situation where trailing earnings are going to be in the 30s. This is an interesting graph. We looked at all M&A deals, and we can go in more detail this afternoon. But as logical, if you got a clean balance sheet, 0 to 2% NPAs, you generally trade at a premium to book value, 100 to 250%. As you get out and have a dirty balance sheet, again, the have and have-nots, 10 to 12% NPAs, they're generally going for about 20, 25% of book value. The break point is right around 5.5% NPAs that determines whether you're going to sell for book value or greater or under book value. So the cleaner you are, the better you are. This afternoon we'll talk about some other ramifications of this. Where's bank M&A going? Heavily the Midwest. Why? There's just a whole heck of a lot more banks in the Midwest. Believe it or not, in Chicago alone we have 220 banks due to goofy unit banking rules back in the 60s. So Midwest, but where's the values? You look at the red dots that are over 150%, Texas, New England. Remember stock values. The two highest trading stock values were New England and Texas. Where bank stocks trade, so go M&A values. What about FDIC? Don't be in Atlanta. If you're a bank, don't be in Florida. Don't be in Chicago. Don't be in Minneapolis. Don't be in the LA area. And there'd be a whole lot of them in Las Vegas, except they never had a whole lot of banks, so those that were there pretty much failed. That's the epicenter of FDICville. On a positive note, that supply is starting to dwindle. But as long as there's FDIC deals out there, just like the early 90s, bank M&A, non-assisted, which is this line, will be depressed as long as there is a supply of failed banks out there. Simply put, buyers get a better deal buying a failed bank than they do buying an unassisted deal. And as long as they can buy a failed bank, they're going to migrate that way. Again, where's the fails occurred? Georgia, predominantly Atlanta area, Florida, Illinois, here we sit at 52, and then California. If you're not one of those states, count your blessings. Are we almost over? Yeah, I'd say we're probably in the 7th or 8th inning, but look, there's still 341 banks nationwide that have Texas ratios of greater than 100%. By the way, bankers in Texas now are trying to change the Texas ratio nomenclature to the Georgia ratio. The Texas ratio came out of the failures of the late 80s and early 90s when academics went and did all these studies and said, oh, guess what? If you have troubled assets that are greater than your capital and your ALLL, it's more likely you're going to fail. Well, now Texas wants to put it on Georgia's back. But there's still 52 banks. As of June 30 data, we're just getting enough call reports filed. We'll have September 30 data probably by midweek this week. But there's still 52 banks with Texas ratios over 300%. I'd say probably 2/3 to 3/4 of those will likely fail. So we still have some more failures to go. I hate to say it, but I've actually heard political overtones that they held back this year during the election year and want to wait until we get through the election to fail a whole lot of them. So we'll see what happens now that election's over tomorrow. So what's going on? Buyers are saying, hey, M&A pricing's lowest level now. That's a good reason to look at being a buyer. There's clearly overcapacity in the industry. I can get operating synergies. I can't grow revenue independently, but with synergies, I can grow earnings per share. So the buyers are starting to understand that a way to make money and grow earnings per share going forward when you have no loan demand is buy somebody. That's why we think buyers are going to get more active. Problems are still, and we'll talk much more about this afternoon, asset valuations and more particularly 141R marks are still there. Marking the balance sheet to market still creates depressed values, and the ability to pay is still impacted. From a seller rationale, guys, I hate to tell you, but one of the clearest indicators of a bank that's interested in selling is the age of the senior management and board if they don't have younger replacements. A lot of guys wanted to sell back in 2005, 2006, 2007, held off. Well, we're 5, 6 years later, and the human body ages every year. I feel really ancient some days. And guess what? As board members that were in their late 50s, early 60s, back in the good old days, they're now in the mid to late 60s, early 70s, and we've lived through hell in the regulatory standpoint, the economic standpoint. They're getting tired. That's one of the reasons we're going to have a tsunami wave of M&A taking place, as well as the operating issues that we faced. Obviously, price expectations have to come back in line. So what are the big issues from an M&A? Asset values still aren't 100% clear. But if we get the housing market back, glass half full, once the housing market comes back, other asset classes will recover. 141R marks will go down. As 141R marks go down, the ability to pay can go up. And I think we'll start having better values from an M&A standpoint. With that, as we saw earlier, trading values. As long as they're trading with 60% down from where they were pre-crisis, the ability to pay simply doesn't exist. You can get the same number of shares, arguably you can get more shares, but the nominal value is going to be down. But if the economy recovers, if housing comes back, hopefully stock values can come back. We'll work through the glut of FDIC transactions this coming year. So M&A could come back. Capital raising. Capital's king, as we talked about. Regulators want you to have capital. A couple big issues that we're going to face from a capital standpoint. TARP's got to be repaid. A lot of TARP that's out there reprices between the fall of 2013 and the spring of 2014, 5 years. It goes from 5 to 9 if you're a C Corp. Treasury's trying to get out of it, so they're auctioning it off, but the banks that issue it still have to repay it if they're not one of the fortunate ones who can buy it back from the Treasury at a discount. Also, we have TRUPS being phased out. So there is going to be a need for capital by the banking sector. And then the third component is Basel III. Lo and behold, we talked about DFA and the rules meant for the big banks. Well, Basel III was always meant for the big banks, but guess what? They're applying it to the little banks. The stress tests are being applied to the little banks, and Dodd-Frank's being applied to the little banks. And trust preferreds were supposed to be phased out only for $15 billion or larger. That's down now to $500 million. So what they say is meant towards the big banks, you're getting hammered with it. So there's going to be a great need for capital still in the industry. One reason why I think you're not going to have dividends pick up. So if you're needing to raise capital, best place to be is a public bank using it for offensive purposes. The whole story in banking these days to get capital is if you've got a use of it that can grow earnings, grow your franchise, there's capital available. If worst case, you're a private bank and need it just to survive or get out from under an MOU or a consent decree, it's going to be very expensive. So what's impacting the capital markets? Again, if you're an attractive bank, an attractive use of the money, you can use it to pursue whole bank transactions, FDIC opportunities, branch acquisitions, or loan growth. We raised $26 million over the past 2 years for a community bank out in the state of Washington that's up in Snohomish County. Happens to be in a market where every community bank in that market of any size failed. $8 billion of assets held by community banks that were in that market that failed. And the last non-fail community bank of $1.4 billion sold out to a big California bank that fired the top 55 people. So you had well over $8 billion of assets that are disintermediated, and this bank grew non-interest-bearing demand accounts by $100 million last year. That's an easy story to sell at. So we've raised $26 million every 6 months. They take it down, continue to have organic growth. One of the unique stories out there and why capital is available to. Without a story, capital's more expensive. Again, where's it going? Acquisition financing. Debt reduction, but that's TARP and TRUPS. Stock repurchases, not so much. Used to be in the days of old, everybody was trying to buy their stock back. Not so much these days. And as we know among the big banks, a lot of them can't even get regulatory approval to do stock buybacks. Growth, yes. This is more defensive. A lot of banks had to raise capital to defend their balance sheets. In today's environment, common's the route, but the bigger you are, you can start to get into subordinated debt. A lot of the big banks are out raising sub-debt. It's relatively cheap right now because there's no yields available anywhere else. But again, this is a case of the have and have-nots. Good banks, good balance sheet story, can get capital at reasonable prices. Banks that aren't so fortunate from a credit quality standpoint don't have the story. It may be available, but it's going to be available a whole lot more expensive terms, typically a discount to book value, and for some of them, it's not going to be available at all. And again, what do the regulators want to see? They want to see common. So what's it do to shareholders? Sad to say, more capital is not good for shareholders. More common equity will dilute the shareholders. Your shareholders were better off having a bank that could operate off a 6% leverage ratio than operate off an 8 or a 10% leverage ratio, because you simply are putting your capital over a lower amount of assets and not able to generate the same returns. In the good old days, banks subscribed for certainly a 15% ROE, and some really good ones were getting 20 to 23% ROEs. These days, high single digit and low teens is probably the new norm. If you need capital, three main sources. The retail market's not there yet. Institutional investors, those big guys that just invest across the spectrum, including banks, it's there. Again, they're picky. They want the right story. And the PE guys are still out there for the right story, albeit the regulators are making life very, very difficult for them in order to invest and go over 9.9% and stay below 24.9. What types are coming in? The big boys are raising senior debt and preferred equity. The little guys are having to do common equity. But again, it's a regional story. It's a have and have not. The bigger you are, the higher the value you trade at. The higher value you trade at, the pricier you can raise your capital at. If you're under $500 million, the average bank trades at 76% of book value. Likewise, the cleaner you are, the better you trade at. Under 1% ROAs, trade at 124% of book value. Over 10%, trading at a significant discount, and those guys probably can't even get capital if they needed to raise it. So, for those of you who are acquisition-minded, what's your options? They are numerous, and I think they're going to continue to be numerous. Branch acquisitions. There's still a lot of banks that need to raise capital, and a route to go is by selling branches, transferring some loans, building their bank-level balance, core capital ratios by shrinking their balance sheet. In the days of old, the good old days, deposits went for 6 to 10%. We sold a branch in Northern Trust out near the airport, 18.5% in the good old days. These days, to buy deposits, you're 1, 3, maybe 5% on the high end. Certain markets, again, are regional, a little bit different pricing, but being able to buy branches right now is much cheaper than it's ever been, so that's an acquisition expansion opportunity for you. FDIC deals, as we said, there's still more to come. If there's 52 banks with Texas ratios over 300, but again, that's regional. If you're in Atlanta and you're a healthy bank, you got plenty of opportunities to bid. Chicago, you still have some opportunities. Market expansion, M&A's coming back. The question is pricing. Again, regional, have and have-nots. But that tsunami wave we talked about. For those of you who want to be buyers, I think you're going to see more and more opportunities. And strategic affiliations, think of this kind of in the form of an MOE, merger of equals, even though many say there's never a true merger of equals. But clearly strategic affiliations of getting together with a like-minded, somewhat similar-sized bank, wringing out efficiencies, having more market share, having more customers, those are going to pick up likewise. But for you who want to be buyers, there's going to be plenty of opportunities. Going back to the branch idea, I'll tell you flat out, and we can show you by numbers, it's much cheaper right now to buy an existing branch location if it's in the right market than it is to go out and build a new branch location. Again, when you can buy an existing bank branch that has 10, 15, 20, 30, 40 million in deposits compared to going out and building a branch where it usually takes 2 years to get your deposit level up to 10 million. You can buy an existing bank that probably has net book value less than market value given they've had depreciation for 5 to 6, sometimes 10 years or more. It's simply cheaper to buy now than it is to build. And lastly, cycles. M&A and bank values is cyclical. It's usually rises and falls with the economy. As the economy rises and falls, values of trading, as we saw earlier, rise and fall. When stock prices are high, M&A values are high. So, this is the time when to be buying branches, explore mergers, buy other companies. If and when, and it's both an if and a question as to when, we get back to a real healthy economy, that's the time to get out. I can't tell you how many guys now regret that they didn't sell in 2005, 2006, 2007. We had a really good community bank in Chicago that we had an offer for $70 million in cash. They wanted 75, held out. Lo and behold, the Great Recession hit. They had a great deposit base, but they happened to do a lot of character lending without security. And even good people in really bad economic times don't pay. We ended up selling it for $3 million. And the option was to fail. So timing is everything. Don't be a day late or a dollar short, and don't hold out for too much because the train may pass you by. So in conclusion, values are still low because of the economic situation. The operating environment is obviously unclear. Some factors say things are going to get better from an NPA and a charge-off basis. Others, due to interest rate environment, says we're under a world of hurt. I think all these lead to a very, very accelerated level of M&A over the next 3 to 5 years. And where the banking sector is 5 years from now could be significantly different from where we sit today. But it should be an interesting ride. Questions? Sitting up here, I don't see any hands, so I either bored the heck out of you.
Steve, I got a quick question
Yes,
for you.
Jack.
It's a powerful mic, I apologize. Talk a little bit about the mismatch in expectations between buyers and sellers. Clearly, we're not going back to where we were 10 years ago with a 2.5 times book marketplace. But there have been deals done over the past 2 years that have been lucky if they even hit book value. Realizing that there were regional differences and differences in types of institutions, what do you see as what would you expect as a range or pricing range over the next 12 to 18 months in terms of M&A transactions?
Good question, and we'll touch on this in much more detail this afternoon when we break down region by region. It is a regional discussion. California right now, a decent bank, NPA is under 3%. There's a lot of buyers, can probably go for book 30 to book and a half. Chicago right now, a good bank, can't sell for much of a premium at all because there's still FDIC deals to get done. Florida and Atlanta, healthy bank trying to sell, don't. Just wait until the FDIC glut works through because you're not going to even get book value. Go to Texas, where life's good, New England, where life's good, and we're seeing values of book and a half and higher. Again, it is a region-specific, a case of the have and have-nots, and clearly specific to the individual institution. As we saw, asset quality is the key driver to value right now. It used to be earnings are most important. Earnings are always important, but they're taking a back seat to asset quality right now. Thank you all for your time. If you have any questions, feel free to come up afterward.